you know, delusional kind of thinking. BRICS don't matter. We're gonna deter the Houthis. We're gonna, I don't know, do what? And the war in Ukraine's going great, and we don't need Russian oil and Russian energy, and the rise of the AfD in Germany is not important. It's all good. It's just unbelievable.
It's quite a strange
And
world.
and Biden won. They had like this thing yesterday. The primary, Democratic primary, he won like 95% of the vote. The only problem was there was only 4% of eligible voters who wanted to vote.
Good morning, everybody, and welcome to the Daily Energy Markets Forum. It is the 5th of February, and we are looking at Brent crude oil trading this morning in Asia at all sevens on the door, $77.72 for Brent, taking a bit of a hit at the end of last week, and then looking like it's stabilizing this morning. Let's kick off, as always, Monday morning with Omar Najia, Global Head of Derivatives at BB Energy. Omar, we're kind of where we were a week ago. Your thoughts on the direction of travel, the sort of sell-off on Friday, the end of last week. What's your insights on that and outlook for this week?
Well, I think basically what we've seen is profit taking. So what happened is that you had a headline saying that a peace deal was agreed. Market sold off, and people kept selling because it was just start of profit taking, and continued into Friday. But there is no peace deal. There is no ceasefire. The US keeps saying it wants to de-escalate, and it does that by striking Iraq, Syria, and Yemen, while at the same time saying we want to de-escalate. We want to de-escalate. So I think I think geopolitically, I think we're heading into a massive kind of war. I think we're on for a Hezbollah thing, and we're on for maybe something bigger with Iran, because there is no alternative. I think the Houthis will retaliate, etc. So just turning to the market, I think basically we are bullish. If WTI has two paths, basically. The destination, I think, in my opinion, is new all-time highs. The problem is not the problem, but it has two ways of getting there: either up from here, or basically it needs to get to below $68. So we're trading about 72, so maybe $4 lower, and then higher. But I don't think there's. I think the world is inflationary. I think equities go up. I think the dollar gets hammered. I think inflation makes a resurgence. I think debt goes stratospheric in Europe and the US. With deficit spending in the US at 2 trillion plus, with elections in Europe and elections in the US, and with wars, I don't see any room for anything except more and more spending. So I like equities, I like oil, I like Bitcoin, metals, you name it. The only question is, the destination is not in doubt in my mind. The only question is from where, whether it's directly from here or a little bit lower.
Let's welcome Victor Yang, Senior Analyst at JLC Network Technology. Victor, let me start by wishing happy Lunar New Year, Chinese New Year to you and all of your friends and family. Your thoughts this early January as we move deeper into the Chinese New Year. What does January look like behind us in terms of the start of the year for Chinese oil demand, and what's the outlook for the rest of the quarter? Your thoughts?
Well, we had this holiday vibe now in China, and people are traveling back home to their hometown for the holiday. And we're expecting to see record high passenger travel during this Spring Festival travel rush. But the problem now is that a lot of provinces, about 16, are facing very heavy snow, and the traffic has been kind of blocked to some degree, and a lot of people are stranded on the road. So this is one of the problems the country is now facing. And we expect gasoline demand is to grow, of course, around the holiday, but diesel demand is now seasonally weak, the weakest of the year, because manufacturing has slowed down. A lot of factories have started holidays, and so we expect very weak diesel demand for the first quarter. It's not going to return until March. And for the whole year's crude demand, we expect much slower growth than in 2023, because after demand normalized, say, imports surged by 11% last year, and the country's crude throughput jumped by 8.7%. And say by the throughput, it grew by 1.25 million barrels per day last year. But we expect the growth will be much, much smaller this year, say until about 100 kbd, because, well, that's also mainly because of the new capacity too. And jet fuel, gasoline, diesel demand is not expected to grow much further for this year. So for the first quarter,
sorry, go ahead. Yep, go ahead. The first quarter.
For the first quarter, and there's not much refinery maintenance. Chinese refineries will maintain quite stable production around the Chinese New Year in January and February, and maintenance will begin in March. For the first quarter, demand will not change much, but we expect relatively low imports in the first 2 months because of the holiday and slowing production.
Let's welcome Henning Gloystein, Director, Energy, Climate and Resources at the Eurasia Group. Henning, I would imagine Eurasia Group's quite busy these days. Between Kepler winning on the shipping front, geopolitics couldn't have been more in vogue than it is at the moment. I'm sure all your clients are ringing around the hook. But thinking about where to look at the moment in the context of which geopolitical crisis trumps the other, no pun intended, where do you think the biggest one from an energy markets point of view we need to be paying attention to?
I'll briefly start with the non-energy part. I think it's the Middle East, and unfortunately, I agree with Omar. It's looks like this is heading for escalation, despite lots of talks of some imminent ceasefire, whether it be. But overall, there does not seem a credible solution on the ground in the Middle East, and there seems to be small but steady escalation from that looks very difficult to stop. And if you spill that over to energy markets, I think there are bigger risks here as well, because yes, okay, the Houthi attacks on the Red Sea vessels have been almost brushed off, especially by the oil sector, not by the container sector, but the Red Sea only affects Europe in that sense. I mean, Northeast Asian oil.
At $77 a barrel, just to push back a little bit, the energy markets doesn't look too concerned about any sort of potential escalation. If anything, the reaction from the Americans over the weekend, while devastating to whoever is under those missiles, clearly they are significant weapons landing on your head. But nonetheless, from a general macro point of view, a continuous containment strategy is underway here by all sides, it would appear, no?
Well, I'm not sure about that, because like I said, that yes, the Red Sea situation has been brushed off by energy markets fairly easily, but if this spreads, and there does seem to be at this stage escalation. We don't have it as our base case that the Strait of Hormuz gets affected, but if it does, then you can be sure that energy markets will react, and so that has the bigger escalation potential. Ukraine war is a catastrophe as it goes on the ground, but in terms of energy markets, and not everyone agrees on this, but I sit in Europe. Europe has overcome that crisis, that part of the crisis, the energy crisis, with fairly well. Some of it is a bit awkward, so there are still some Russian flows to Europe, but they've been vastly reduced. But in terms of, you asked the general impact on global energy markets, it is the Middle Eastern crisis that is much more threatening at this stage than the crisis in Ukraine. Whereas in terms of humanitarian impact and geopolitical impact, both are really, really bad. And sadly, neither of them have a really credible solution as we speak.
Omar, in the context of the sort of, obviously the geopolitical issues are dominant in multiple ways, but ultimately, as speaking with Victor, there are others, there's fundamentals from the market point of view. Where do they look like for you from an outlook point of view? Is that bullish, the sense of potential chaos, but nonetheless, is there a demand supply bullish narrative there? Or how do you build a long sort of have a long view at the moment?
So about 20 years ago or more, the oil market stopped being a real commodity market and became like a financial market, became very financialized. So you've got about 100 million barrels of oil that trades a day, or of demand basically a day. That's physical, actual, real oil. 80% of it you don't see because it goes directly from one end of the world to the other. 20% of it is traded. So on NYMEX alone, let alone ICE, you get, you get much more than that trade a day. So supply and demand is very interesting, but it's kind of, it's fundamentals and all this kind of, I call them and then mentals, because really, I mean, they really don't impact the markets to such a big extent. What I think happens is when markets are going down, when markets are bearish, then basically people come and start arguing about fundamentals. You get issues with storage and contangos. Then you can look at basically, demand, supply, fundamentals, blah, blah, blah. But when you're in a bullish market or a market moving sideways, fundamentals just really don't play that big of a part. I think basically the drivers for the oil market now are geopolitics, for one.
I mean, they don't seem to be putting their whatever metaphor you want. I mean, the momentum at $77 on Brent, and we've had a few pop-ups, but ultimately there's a downward draft on this oil market, isn't there?
Yeah. So basically what you have to understand is the oil markets don't work like a story comes out, people buy, a story comes out, people sell. It doesn't work like that. So basically people who sold on, last week had already bought before any story came out, and they, et cetera, et cetera. So basically what you're seeing now is basically people deleveraging, coming out of positions, blah, 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 wait and see attitude, and then the next leg happens. So basically, I don't think it's basic 1 + 1 and buy now, sell now, and follow the news cycle. So I think basically that the markets will react when they are done basically with clearing the decks. And there's the chances of clearing it, the decks having been cleared here, in other words, the low is in and we're going to move higher, are about 50-50. With either low is done here, we move higher, or we test below 68 and not very far below 68, and then the market goes up. So directionally, you want to be long, and you just need to basically decide how much pain you can take and how early you want to get in. But I don't think fundamentals really don't change, right? So if you're looking at markets and you want to look at the fundamentals, they're not going to change day by day or second by second or week by week, whereas basically the markets do. So I think that's giving you a clue that, yes, okay, as a background thing, look at them. If the market is cratering, look at them. But in terms of day-to-day trading, not very useful.
Fundamentals. I'll have to put that on my That's like, is that a bumper sticker in Texas? Maybe a bumper sticker in Texas. Victor, I wanted just to get a sort of better understanding of a few things you made in your opening comment that seemed a little bit of a contradiction to me. You're expecting record travel data in terms of the Chinese New Year, people going on airplanes and all the different ways one would travel for this holiday season. And yet you don't expect an energy demand growth story or an oil demand growth story. I mean, when you see that many people traveling, that would reflect economic confidence rather than economic weakness. How do you put those two things together? Record travel, bearish outlook.
Yes, record travel, and for gasoline and jet fuel demand is still growing, but much slower than in 2023. Say for travel, we expect it to grow from 2019 by about 3.4%. So it's basically boosting gasoline and jet fuel demand. But after the holiday, it will return to normal. And compared to 2023, there wouldn't be much difference. Jet fuel demand will grow relatively fast as it recovers further. But diesel demand is not growing much further anymore because the real estate industry is weak. And a lot of sectors that consume diesel is not strong. So we still see some growth in gasoline and jet fuel demand, but not little growth in jet fuel demand. And this growth is quite small, well, because the consumption already normalized in 2023 and the base is quite large. So that's quite different from 2020.
Now, what does a weak diesel demand tell you about the Chinese economy at this time?
Well,
manufacturing's weak.
Yes, we know China's GDP grew by 5.2% last year, and we expect it to slow down in 2024. And this is because
below 5.2%.
Yes, maybe slightly below 5%. A lot of challenges, and we are facing more uncertainties in the world, including the conflict, Hanning and Omar mentioned, and a lot of exports to the United States declining, and a lot of issues with international demand and domestic manufacturing. So the growth is not even. Does not mean every industry and every sector grows. Say in 2024, some industry didn't grow. Say the real estate industry, some constructions, and it was mainly from some sectors like the service industry and some technological sectors. So that's imbalanced development. And so we will still see this in 2024. Yes.
Henning, I wanted to get your insights on the developments with the Ukraine-Russia conflict over the last few days and certainly the last week, where it looks like Ukraine are taking, they're sending drones deep into Russia, attacking energy infrastructure, refinery, and so forth. Is that a game changer? Is that a significant development? What's your thoughts on that and the outlook for that as a new ongoing strategy?
So yeah, it has happened. The attack on Russia's Baltic Sea export facility a week or two ago, it was more than 1,000 kilometers away from Ukraine. So it tells you that they have some form of ability to strike well outside of the actual war zone. It's not the first time. It's probably not going to be the last time, but it's definitely increasing. So we're not quite certain whether it coincides a little bit with Ukraine's counter-offensive that didn't go as planned. Definitely not. So it looks like the conflict on the ground is pretty much stuck at this stage. And both sides are looking for other ways to inflict pain, damage on the other. It's probably worth noting that in Ukraine, there's a bit of an internal spat going on now as well, between President Zelensky, head of the military, and so there's a fair few moving parts here that are difficult to understand from the outside, to be blunt. But I think they all point to the fact that the actual conflict on the ground for Ukraine has stalled. It's last year's big drive to regain some lost territory. But Russia is at this stage also not able to move Ukraine much further back. And that means that the conflict is sort of metastasizing into different areas.
We saw yesterday the U.S. Senate passing a bill to try and fund the next round of funding for the Ukraine, which is combined into a everything in the bucket bill, but with Israel funding, what else? Security at the border with Mexico funding, etc. So a big $120 billion funding bill, of which half is for Ukraine. How critical is that? What's the outlook for that? Because that still would have to pass through the House of Representatives, which seems unwilling to pass that bill.
So provided it does pass, it is critical, and it comes hot on the heels of the European Union managing to get its 50 billion euros of aid sort of approved. But it's slow. I mean, this is not exactly going to, as you say, I mean, the US, this will take longer to even, if it does get approved, and the EU stuff won't immediately get transferred onto some Ukrainian account. And this delay has significantly weakened Ukraine. So any money that is approved now only has a trickle effect. It comes through later. And the war is ongoing in the meantime. I'd say, though, without that help, that support, Ukraine would have been in a pretty dire position well before anything that happens in the US and its election. So this aid from Europe and then probably in the United States this year will probably give Ukraine pretty strong financial support and help it not get worse. But whether it comes in time to actually allow it to strengthen its position further is unclear. And sadly, we in our top risk, we think Ukraine is stuck and probably headed for a partition.
Let's go to the survey question on where we're going, at least in the immediate sense, with the oil markets. What will have a bigger bearing on the direction for oil prices through the rest of the first quarter? We've been asking this question on social media today. The outlook for geopolitical premium, which seemed to drop out of the market on Friday on the back of the news that maybe the parties to the conflict in Gaza were finding some pathway to an agreement. The Fed interest rates, which seem to have been totally recalibrated from now and multiple to maybe in the second half of the year. OPEC supply cuts, none of the above. Which will have the bigger bearing on the direction for oil prices through the rest of the first quarter? And where does that go? Omar, I wanted to get your sort of outlook for where, I mean, you mentioned there in your earlier comments where we are testing resistance levels, etc. We're kind of, moved quite firmly higher earlier in January, in the middle of January, and then ended the month sort of coming back down again, and we haven't been able to break higher, even with fairly substantial growing, as you mentioned, and as Henning mentioned, the Middle East in the last weekend alone had U.S. missiles dropping in Syria, in Iraq, in Yemen, and U.S.-made missiles dropping in Gaza. This is escalating on the battlefield, but not necessarily in the markets. I'm just wondering, where do you see the sort of momentum from floor and ceiling in terms of resistance levels?
So I think basically in terms of, in terms of the market, what you need to do, when you have large positions, when you want to sell, you need to have a large enough buyer on the other side. So people usually sell into strength, right? So the indication that they sold into strength is not an indication of quote unquote bearishness. They wait for the news that, they've launched, market goes up, they sell that strength, right? Because you need volume to sell, et cetera, et cetera. So I think right now, if you look at WTI, it's trading about 72.50 plus or minus. Below 68, I would buy as a strategic, thing. I am bullish the market. So below 68, I would buy. If the market gets above the high, which was about 77.50, something like that, then I would buy. But in terms of, if you asked me right this 10 seconds, would I be long or short? I would be long. We sold a lot of stuff. We're still holding like small positions on the long side. And I would only add if we get below 68, and I would wait to get above 79, 79.60, and then add. And basically it's a 50-50 toss-up. I think my gut feeling is we go up from here. We don't test below 68, because if we test below 68, it's going to be like a quote unquote perfect scenario. Everything will line up. I think geopolitically we're going to hell. So if we get below 68, like, very slightly below 68, 67, 80, something like that, then I think everybody's going to be like loading up. And I don't think markets give you such opportunities ever. So again, 50-50, but on the basis of that, I would be long, and I would be getting long now. I think the low that we saw at 71.80 should be it.
Victor, I mean, alongside Omar buying at these prices or lower, China likes to buy at these discounts as well, but yet your outlook is not very positive for Chinese buying, even if the price is right. What's your thoughts on that? I mean, the Chinese are usually opportunistic buyers at the right price, regardless of domestic consumption.
Yes, well, if the prices are appropriate, and the Chinese refiners would buy more, say like in the first half of 2023. But if prices go up to, say, above $80, this could dampen their demand further. But when we are talking about the actual demand, it is not growing that much. And so if prices are too high, this demand would be depressed further.
And when you look at Chinese demand, just a few things. First of all, just to reiterate your earlier comment that you expect that demand growth in China this year, 2024, will only be 100,000 barrels a day on average through the year.
Yes.
That's it, right?
Yes, that's based on the actual demand, not speculation. Not if prices will go up, say, to $70 or even lower, yes, the imports could be larger. Yes, could be larger.
But the imports could be, if they were larger, they would go into storage?
Yes, going to storage, yes.
But actual consumption will grow your forecast by only 100,000 barrels a day,
yes,
in
about
24
yes.
for consumption.
Yes,
Any extra buying would go into storage.
Yes.
Okay. Thank you. I just wanted to get that clear. Henning, I wanted just to finish off on the last point you made there, which I think is quite an important one, obviously, and it's something that has been building for a while, and it's maybe two sides of the same coin. You mentioned in your last comment that Eurasia Group expect that Ukraine is heading towards partition, which I suppose more or less it has been since 2014 when Russia took Crimea and obviously the Eastern Province. But ultimately in this war, which is about that territory, you're expecting the partition, and the very likelihood, at least 50-50 in an election, that Donald Trump comes back. So my question ultimately is, is Europe adequately preparing? Is it prepared for those two outcomes, which may end up being exactly if Trump comes back, even if the Ukrainians get this money, it sort of all points to the end game and partition. How are Europe prepared for that? What do they need to do to prepare for that?
Europe isn't prepared for a possibility of a Trump presidency at all. It's financially, mostly in the security space. So if Trump comes to power, Europe basically has to calculate its defense budget in a way that does not include much support from the United States, which would mean require raising its defense budgets And we talk about this a lot here, is if you have to raise your defense budget, and you have to raise your spending for all the retiring baby boomers, and to address for climate change and for all other stuff, all you're going to do is spend more money and look at those debt distress levels then. So this is, Europe is in no way prepared for this, for that sort of outcome. There are some Europeans who think, who quietly hope, well, but if Trump comes to power, he will immediately enforce a permanent ceasefire on the ground, and that's what we kind of quietly wanted anyway at the start of this war. Might be true, but still, it does not mean that a Trump presidency would make life for Europe much easier, because Mr. Putin would somehow, he would try and spin the war in Ukraine into a full victory, and in some ways he would have gained lots of territory, and you know, all of the rest of the European Union's eastern border would feel very, very destabilized. And
if there was to be this sort of partition, as you call it, in Ukraine, and the territory that Putin or the Russia would secure, take, whatever is the correct language, is this the same territory more or less that Russia has been engaged or holding or part of since 2014, or is it more than that?
More. I mean, take Mariupol, for instance, flattened city. He created the land bridge. I mean, worth keeping in mind that, you know, Russia tried for it all. They wanted to depose the government in Kiev and basically control the entire nation, which that part failed. But Russia is now in control of more land than it was at the start of this current war in February 2022, and more than it has had under control since 2014, significantly more. And it's taken out a lot of population, so the land it controls now is almost entirely ethnically Russian, because all the ethnic Ukrainians have been, you know, they're not there anymore.
Ethnically cleansed. Well, there's the answer on this. The biggest bearing on direction for oil price through Q1 will remain to be geopolitical premium, and we'll have to see if that gets inflated back into the price. Brent trading this morning just up a few pennies at 77.64. WTI trading at 72.49. They're both up about 1/3%. Thank you so much, everybody. Great to have Omar Najia, as always, Monday morning. Henning Gloystein, as always, thank you very much for your insights. And Victor Yang, no better man to give us an update from China. Really appreciate it. All the best. Have a great week. Take care. Here every morning, 10:30 UAE time.
Thank you.